friends, welcome back to the Investing Iguana. I'm Iggy, and if you're new here, I've been analyzing stocks, finance, and wealth building strategies for over 5 years. Our channel was recently ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 800,000 reads and 250,000 watch hours. In today's video, we're going to explore how a second Trump presidency may affect the economy and your portfolio. Now, I know some of you might be thinking, Iggy, how can we prepare for something that hasn't happened yet? Well, my friends, as the great Warren Buffett once said, price is what you pay, value is what you get. We're going to focus on the value of being prepared, regardless of the outcome. According to Oxford Economics, a second Trump presidency could lead to 2 possible scenarios, the limited Trump scenario and the full-blown Trump scenario. In the first scenario, we can expect higher spending levels, reduced immigration, and targeted tariffs on China and the EU. In the second scenario, we can expect even higher spending levels, lower corporate tax rates, reduced immigration, and across-the-board tariffs on major trading partners. Both scenarios would likely push inflation above the baseline, which could have significant implications for your portfolio. But don't worry, friends. We're going to break it down and explore which sectors will boom, which will bust, and most importantly, how to protect and grow your wealth during this major economic shift. So, let's dive in. Market response to the Republican sweep. My friend, let's break down what's happening in the market. The Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite are 3 major stock indexes that give us a sense of how the market is performing. The Dow Jones Industrial Average is the most well-known and longest-running market index, consisting of 30 blue-chip U.S.-based companies. It's a bit limited in scope, but it's still a significant indicator. The Nasdaq Composite includes over 2,500 stocks traded on the Nasdaq exchange, and the Nasdaq 100 includes 100 large non-financial stocks. The S&P 500 is a broader index, including 500 large U.S.-based publicly traded companies, representing about 80% of the value of all publicly traded companies in the U.S. It's considered a better gauge of the market's performance. Now let's talk about the current market situation. The numbers you mentioned, Dow Jones Industrial Average at 43,958.19, S&P 500 at 5,985.38, and Nasdaq Composite at 19,230.72 indicate a positive market response to the Republican sweep. Investors are optimistic about Trump's pro-business agenda, and we see that reflected in the steady climb of these indexes since the election. Economic policy changes. Let's dive into the economic policy changes that Trump 2.0 has in store for us. The cornerstone of his economic plan is centered on massive tax reforms, and I'm excited to break it down for you. The corporate tax rate is set to drop from 21% to 15%, which is a significant decrease. But what does this mean for businesses and individuals? Well, for S&P 500 companies, this could boost earnings per share by an estimated 7 to 9%. That's a pretty substantial increase if you ask me. But here's the thing. It's not just about big business. Small business owners and individual taxpayers will see significant cuts too. This is because the tax reforms aim to benefit everyone across the board. Now, I know what you're thinking. How will this impact the economy as a whole? Well, according to some analysts, this could raise the level of real GDP by 0.6% higher than the baseline in 2027. That's a pretty positive outlook if you ask me. However, it's essential to consider that there are different scenarios and outcomes depending on the extent of the tax cuts and spending levels. Some analysts have modeled 2 scenarios, a limited Trump scenario and a full-blown Trump scenario. The first scenario assumes a Republican-led Congress extends personal tax cuts and enacts higher spending levels, while the president uses his powers to reduce immigration and impose targeted tariffs. In this scenario, inflation would rise, but the impact would be somewhat limited. On the other hand, the full-blown Trump scenario assumes Republicans prevent the expiration of personal tax cuts, cut corporate taxes, and agree to even higher spending levels. At the same time, the president would curb immigration to a greater extent and impose across-the-board tariffs on major trading partners. In this scenario, inflation would be even higher, and the renewed trade wars would more than offset the benefits from lower taxes, dragging down the level of real GDP. Inflation and interest rates. My friend, let's talk about inflation and interest rates. The latest data shows inflation is currently at 2.6% annually, with core inflation at 3.3%. Now, you might be wondering why this matters. Well, my friend, it's because Trump's policies could potentially push these numbers even higher. And that's where the Federal Reserve comes in. They're facing a bit of a delicate balance here. On one hand, markets are pricing in an 83% chance of a rate cut in December. But on the other hand, Trump's proposed tariffs could force the Fed to maintain higher rates longer than expected. It's a bit of a catch-22, if you will. The Fed wants to keep inflation in check, but at the same time, they don't want to stifle economic growth. So they're walking a tightrope here, trying to balance these competing interests. Now, I know some of you might be thinking, Iggy, what does this mean for me? Well, my friend, if inflation continues to rise, it could impact your purchasing power. That means the same dollar won't go as far as it used to. And if interest rates go up, it could affect your mortgage payments, credit card debt, and other loans. So it's essential to keep an eye on these numbers and adjust your financial plans accordingly. Trade war impact. Let's now dive into the impact of the trade war on your investments. The proposed 10-20% blanket tariff on imports is a big deal, and I want to break it down for you in simple terms. Essentially, this tariff could be a double-edged sword for American companies. On one hand, companies that heavily rely on imports could see their profit margins squeeze. Think about it. If they have to pay more for the goods they import, that's going to eat into their bottom line. This could be bad news for companies like Apple, Walmart, and even automakers like Ford and GM, who rely heavily on imported parts. On the other hand, domestic manufacturers might actually benefit from this tariff. Companies like Caterpillar, John Deere, and U.S. Steel, who produce goods locally, could see a boost in demand. Why? Because if imports become more expensive, companies might start looking for alternative suppliers within the U.S. This could lead to an increase in sales and revenue for domestic manufacturers. Now, I know some of you might be thinking, Iggy, this sounds like a classic case of winners and losers. And you're right, the trade war is going to create both. But here's the thing, my friend. As an investor, you need to be aware of these dynamics. If you're invested in companies that rely heavily on imports, you might want to keep a close eye on their profit margins. On the other hand, if you're invested in domestic manufacturers, you might be in for a treat. Just remember, the trade war is a fluid situation, and things could change quickly. So, stay informed, stay vigilant, and always be ready to adjust your investment strategy accordingly. Iggy's proposed investment strategy. You see, I believe in a three-pronged approach to navigate the current market landscape. Firstly, I recommend overweighting U.S. domestic companies with minimal international exposure. These companies are poised to benefit from tax cuts without the tariff headaches, making them an attractive addition to your portfolio. Think about it, my friend. With reduced tax liabilities, these companies can invest more in growth and increase their profitability. Secondly, I suggest taking a closer look at infrastructure and defense stocks. Trump's emphasis on domestic manufacturing and military spending could be a boon for these sectors. We're talking about increased government spending, my friend, which could lead to new projects, modernization, and growth opportunities. Lastly, I recommend maintaining a gold position as a hedge. With increasing policy uncertainty and potential inflation, gold could serve as valuable portfolio insurance. You see, gold has historically performed well during times of uncertainty and inflation, making it a smart addition to your portfolio. Now, I know what you're thinking. Iggy, this all sounds great, but what about asset allocation? Well, my friend, that's a great question. Asset allocation is key to any investment strategy. You see, it's all about finding the right mix of investments that align with your goals, risk tolerance, and time horizon. For example, if you're a younger investor, you may want to consider a more aggressive asset allocation with a higher percentage of stocks. But if you're closer to retirement, you may want to consider a more conservative approach with a higher percentage of bonds and cash. Asia's resilience. For my Singapore and Asian viewers, here's some good news. Asian economies have significantly strengthened their financial position since the last trade war. We're talking about improved current account balances, higher foreign exchange reserves, and more flexible exchange rates. This means that Asian countries are better equipped to weather the storm this time around. But that's not all, my friend. Our region's tech manufacturing capabilities, particularly in semiconductors, remain crucial to global supply chains. Think about it. Asia is home to some of the world's most advanced tech manufacturing hubs, like Taiwan, South Korea, and Singapore. These countries have invested heavily in research and development, creating cutting-edge technologies that are in high demand globally. And let's not forget about China's dominance in the global supply chain. It's still the world's largest exporter, accounting for over 13% of global exports. Now, I know some of you might be thinking, but Iggy, what about the impact of tariffs on Asian exports? Well, my friend, it's true that tariffs have had a significant impact on Asian exports, particularly in the short term. However, many Asian countries have been diversifying their export markets and supply chains, reducing their dependence on any one market. This resilience is a testament to the region's adaptability and determination. If you found this analysis helpful, please hit that like button and subscribe to stay updated on market-moving events. Next week, I'll be diving deep into specific stock picks that could benefit from these policy changes. Click the bell icon so you don't miss it. And before you go, I've got something special for you. If you found this analysis valuable, you're going to love my latest video, Trump versus the Fed 2024. In that video, I break down the brewing conflict between Trump's economic agenda and the Federal Reserve's monetary policy. You'll discover how this power struggle could impact your investments, what defensive moves to make, and which sectors typically thrive during periods of policy uncertainty. I also share my personal strategy for navigating these choppy waters, including specific ETFs and stocks I'm watching. The video has already helped thousands of investors prepare their portfolios. You'll find it linked in the top right corner of your screen or in the description below. Don't forget to hit that subscribe button and notification bell to stay ahead of these market-moving events. Thanks for watching, and I'll see you in the next video.